Today we're going to talk about one of the best UK dividend stocks, if not the best UK dividend stock out there. It's a stock or a company that I felt like it deserves its own video. I have not done that for this company. I last talked about it on free UK stocks to buy January 2021 edition. Since then it has had a very good year, and even after a very good year, I still think it's really important. It's one that you add on to a watch list and keep track of, because it is a good company to add into your portfolio. Now this stock is very unique because it has the perfect match of everything, where it has a really good dividend, a dividend that has a very good yield, and they'll be ramping that up. But as well as having a very good dividend, this company is actually nearly a growth company because it puts in some really impressive revenue and profit, which is the ultimate combination which we all want to own. So hope this video is useful. If it is, hit that like button. If you're new, subscribe, and we'll take a look at this stock. So this stock is Airtel Africa. It trades on the ticker symbol AAF. It is on the London Stock Exchange. It was founded in the 8th of June 2010, so still a relatively new company. And what it does, it has two income streams, one of them being telecommunications, mostly in Africa, and also mobile money services, and once again that is in Africa. Now it is currently a 5 billion market cap company, so this is a pretty decent size for a UK stock really. Most of the time we're talking about under 1 billion, so pretty good going here. It does trade around a 13p ratio, which is very cheap, but we'll talk about that in a little bit. And the dividend yield is currently 2.53% according to Google, which is a pretty impressive dividend amount. Now the stock came onto the stock market in 2019. I picked up shares around the start of 2020, and it was one of those stocks that IPO'd and then it actually fell off a cliff, and I started buying. And since I started buying, I'm currently up 100% on this investment in 2 years, but I have no plans to sell because I still think it's going to be a fantastic company with a lot of growth. And I also think it's got a very good dividend that I'm really happy to pick up, and a great one for the portfolio, just to give that diversification from a lot of growth companies to having a company that's profitable and pays a really nice dividend as well. Now one of my errors here is that I should have really picked up more shares, and even through 2020 and 2021 it's probably a stock that I should have bought a bit more of. It's a company that I have looked at and I thought, you know what, one of my biggest errors this year is, sure, it was great investing in this company, but I really should have bought more of this company. And going forward into 2022, I will be looking to pick up some more shares of Airtel Africa up if I can. I probably won't be buying them at all-time highs, because if you look, it has been a fantastic year and been on a good run, even though the valuation is still cheap. But if I can get this on, say, a 10-20% drop, which it does have every so often, if you look here, if we go to the 4th of December, 20% drop right there. If it does have a 10 or 20% drop, it will be a company that I own that I will look to average up on, because I think it's worth having this as a big position in the portfolio. Now, originally when it came onto the stock market in June time, it was an IPO that flopped. It obviously came onto the stock market, and since it came on through the stock market in June, it did what a lot of IPOs do, and it just fell off a cliff. And when you have stocks that IPO and it's a good company, and all of a sudden you get gifted this chance in the first 9 months where it's an absolute fail and the share price loses half its value, sure, the CEV kind of helped this one lose that much, or that much value, but quite often these come really good buying opportunities. And I'm sure if you've been following the channel for a very long time, you know one of my favorite things to do is track IPOs, and when the IPOs get to about 9 months in after the IPO, see if the share price drops off. And if you have an IPO that drops 20, 30, 40, in this case 50%, quite often I like buying them IPOs. I've done it multiple times, as a lot of you guys that follow the channel may know, and this was one of them. I looked at it and think, okay, this IPO has flopped and it's lost half its value, but the company inside is doing really well, and I took that opportunity to buy this one. Now, even though this has been very good over the last 2 years, I still think this is a really good opportunity and one that I would really like to buy more of, because I do think it has a bright future. Now, like I said, with this company, it actually has two massive income streams, technically three, but I'm going to say two, and that's what I really like about this company, is that it does have quite a decent moat out there, and it is in very big growing industries in Africa at the moment, which are still quite early on the development stage. So one of their income streams are the voice revenue, so this is obviously mobile phones, and you'll see here that this is actually one of their smaller growing sectors, which is 17%, still pretty good going. The next up of their income is their data revenue. So over in Africa, quite often what happens is a lot of mobile usage or data usage is used through the phones. So if you imagine what we might do quite a bit is go on laptops, for example, computers, just to surf the internet, which I know quite a few of us still use our mobile phones, but as well as that, we probably will use some other devices. In Africa, a lot of the usage for data and internet is used directly on the phone, so there's a big demand for a lot of the data in here. Now, the data side of it in Africa is still very early on, so the amount of coverage is still very limited in Africa, and as well as that, the coverage as well, they've recently got 3G, they're slowly starting to move on to 4G, and 4G is still very early in the days, and then you've got the 5G ramp up as well in the future. So when you look at the data side of it, this has a lot of room for ramp up at the moment, and like I said, it's definitely, data usage is used a lot more in Africa, and this is one of the big income side of it. So you can see here, this was 33% growth as well. Now the next other income stream is mobile money. So in Africa at the moment, there's not too much technology for transferring money to each other basically, and one way that is happening now is through Airtel Africa. That's one of the payment methods out there. I know Stripe are massively expanding over there, and this is a massive growing area. Now this sector in particular might see a little bit of a slowdown in future years. I think some of the demand and the surge and some of that revenue is being brought forward because of the CV situation, very similar to the likes of Square, the likes of PayPal. But mobile money and transferring money to each other through platforms like Stripe. Worth saying that Airtel Africa's partner for this is actually MasterCard, and I do believe that MasterCard could potentially acquire Airtel Africa later in the future. And one thing that I think is being considered here is the actual mobile money part of this platform is being talked about getting separated from the company. So we could actually see this being a separate IPO in a few years' time. I think for them to do that, they need to get this the amount of revenue that is coming from this platform, because obviously it's the smallest part at the moment. They need to get this up a fair bit, so it might not be for a little bit just yet, but while it's still growing at the rate it is doing, which is 42%, is pretty good going. But yeah, obviously then you got a lot of income streams going on here with your voice revenue, your data revenue, mobile money revenue, and also some other revenue here, which still grew at 21%, which is still pretty impressive. But overall, you can see a breakdown of the revenue of this company, and you can see here the growth that's going on here. And going forward, voice revenue, data revenue will continue increasing, and also mobile money will also increase, because this is very early in its adaptation stage in Africa at the moment. Now, because of the huge revenue growth, this also led to underlying EBITDA having a massive growth, and what was also really impressive as well is these margins were improving. So you'll see here from September 20, they were doing 44%, and their underlying EBITDA margin now has gone up to 48% in September 21. And when you look at the bottom figure, when you look at profit before tax, that led to a massive 100% growth, and profit after tax led to a massive 131% in growth as well. Now, from a metrics point of view, this company still doesn't look too bad. It is a little bit on the higher end because, like we said, if we go back to the stock, it's had a fantastic year, and this is why I think potentially if I can see a 10-20% pullback in this company, that's where I'll be happy to average up on. But from a metrics point of view, it is a little bit higher than what it normally is, but it's not crazy high. So if you look at total enterprise value to revenues, you can see historically it does sit around about a 1, and we are just above a 2 right now. So like I said, a little high, but nothing absolutely crazy. And if you look at a total enterprise value to EBITDA, you'll be able to see that we normally trade around a 2 or a 3, and we are just entering a 4 here. So like I said, the valuation isn't cheap on this one from its historic metrics point of view, but when you consider the actual metrics themselves, they do stand out as being really cheap. So it comes to your point of view of, do you think these metrics are cheap and they could have metrics that expand and that will help the value going up, or do you think it will stay in its historic value range? So that's one for you guys to answer. Personally, in my opinion, I think it's a combination of both. I think they do deserve to trade at a bit of higher metrics than this, but at the same time, I would not expect them to get too far away from their historic values. Now, going on to Simple Wall Street, they actually have this company being 44% undervalued. Make of that what you want. I know there's a lot of questions around Simple Wall Street's valuations, but from a price to earnings point of view, it is down at a 13. Now, considering the market average is around about 20, which they've actually got down here, which they've got down as 19.6, that's not too bad. You can see here that compared the company to the market average, it is very much below the market average, and I feel like this is a company that does probably deserve to trade around that market average with when you consider the growth and the dividend going forward. The industry is around about a 14. as historically telecom companies do tend to go at lower P ratios, but I don't think this is your normal kind of telecoms company really, because it has so much more growth because of the region that it's operating in, and that's at really early stages. Now, if you look at the future growth here, you can see here they are still expecting, or analysts here, which there's 8 covering the revenue, 5 on the earnings, 7 covering the revenue, and 4 covering the earnings in 2024. They're still expecting revenue and earnings to move in the right direction, not as much as what it has done previously, because previously, it's been on absolute fire. Personally, for me, I do expect Airtel Africa to somewhere grow around that 10% revenue rate, even if it was to decrease to something like 6, 7 or 8. That's still massive amounts of revenue that will really benefit the company. And on an earnings point of view, I will expect the earnings to somewhere grow roughly around the same rate. Now, at the moment, analysts are predicting it to be even faster than that, but even if earnings as well grew somewhere around 7 or 8%, that will still be a very good improvement on this company, and more than your average dividend stock. Now, the company itself, as you can see, this is the past growth, which is really good. The profit margins have been in and out a little bit. If they can continue to improve this profit margin, obviously that will make a massive difference going forward. We'll see if they can do. The only little threat that I do see to this is the amount of competition, and if that does put a bit of pressure on the profit margins, that would be the only kind of risk I see to this. But if it can still keep around that 10% profit margins, that'd be really good. But if the future, maybe in the next 2, 3, 4, 5 years, if we do kind of get back to this point of view where it was 11, 12%, that'd be pretty impressive, and that will mean more profit as well going to the bottom line. Financial health wise, it's not too bad. It used to have a bit of an ugly balance sheet. Recently, it's not been too bad. In fact, it's also been paying down a little bit more debt on the balance sheet as well, as you can see. To do that, it has sold off some little stakes in the businesses, but that balance sheet does look a lot better than what it did previously. Now 74% debt to equity. And if you do look at the balance sheet here, it's got 2.6 billion in debt, and the cash is currently sitting around 800 million, which I'm pretty happy with that sort of balance there. Going on to the dividend, it does currently pay a 2.5% dividend yield compared to Simply Wall Street. Mine's slightly different because of my average being a little bit lower, so I do get slightly more from this, but even so, at a 2.5% dividend, that's a very healthy dividend, as well as that you've got a company that I think will appreciate in share price as well, because it will have that revenue and profit growth going forward. And analysts are currently projecting that this dividend will get hiked up a little bit. You can see here they're expecting a 2.9, 3.3 and then a 3.7 in 2 years' time. I think they will carry on hiking that dividend up if they continue increasing that revenue. If they increase the revenue, you should see more profit, and that will be rewarded to shareholders. So I think these are pretty fair assumptions from them at the moment. So overall here, you can see this is a company that is performing very well, good revenue growth, good profit growth, and I think that will still continue at some very good rates, not as what it's done previously, as I feel like that was a bit of a surge from the CV situation, but going forward, I still expect near close to double-digit profit and revenue growth, which will be pretty impressive, and I think that will also be returned to shareholders through a dividend. So you consider here, you're going to pick up a stock that has a very decent dividend yield, and also quite often when you get these decent dividend yields, you're normally picking up a company that only grows 2-3%. Obviously, that's not the case with this company. It's absolutely smashing it. So even though this company has been on a very good run, I would like to see a pullback of 10-20%, but it is a company that I would like to own a few more shares of, and if it does have one of those dips, I would like to pick up a few more shares, and I should have probably done it through the last 2 years as well, to be honest with you. So yeah, that's me talking about Airtel Africa. I felt like it deserved its own video. It's a company that's done very well for me, and I think it will do well going forward. And yeah, I hope you guys found that information useful on that one, and if you did, hit the like button if you're new, subscribe, and I'll see you next video.